Most people spend their entire working lives trading hours for money. They show up, they work, they get paid. Then they spend it, then they go back and do it again. For decades. And somewhere around year 30, they look up and realize the math was never going to work. Because in that system, the moment you stop working, the money stops too. But there is a small group of people who quietly broke that equation a long time ago. They still have jobs sometimes, they still work. But they also wake up on the first of every month knowing that money arrived while they were sleeping. Not from a side hustle, not from selling something, from investments that generate income on a schedule like a second paycheck that never calls in sick. The question is not whether these investments exist, they do. The real question is why almost nobody builds them. Here is the paradox most people never examine. When the average person thinks about investing, they imagine something they check on an app, a number that goes up or down depending on the news. They measure success by whether the account grew this year. What they're almost never taught is that there is a completely different category of investing, one where success is measured not by what the asset is worth today, but by how much cash it deposits into your account every single month regardless of market conditions. These are income-producing investments, and the reason most people never own them is not that they are complicated or inaccessible. It is because nobody frames wealth building around income first. They frame it around accumulation, but accumulation without income is just a number. Income is what actually changes your life. The principle at work here is called passive cash flow. It sounds simple, but psychologically it represents one of the most difficult shifts in financial thinking most people will ever make. Passive cash flow means your money is working on a schedule independent of your effort. The investment earns, distributes, and deposits whether you are present or not. The reason this matters psychologically is that most people operate under what behavioral economists call an effort-reward belief system. They instinctively feel that income must be earned through labor. Money that arrives without direct effort feels either too good to be true or somehow fragile. That belief, more than any knowledge gap, is what keeps people stuck in the accumulation trap their entire lives. Research supports this more than most people realize. Studies on financial behavior consistently show that people dramatically underestimate the role that regular income plays in long-term wealth stability. A Vanguard analysis found that income-generating assets, particularly dividend-paying equities and real estate, provided significantly more behavioral stability for investors during market downturns. In other words, when people received monthly income from their investments, they were far less likely to panic sell. The cash flow acted as an anchor. It reminded them the investment was working even when the price was falling. That psychological protection alone changes outcomes over a lifetime of investing. The deeper psychology here connects to something called hedonic adaptation. Human beings are wired to adapt to whatever they experience consistently. When someone receives a monthly payment from an investment, even a modest one, it eventually stops feeling extraordinary and starts feeling expected, normal. And once it feels normal, they want more of it. This is one of the rare cases where hedonic adaptation works in your favor. The habit of receiving passive income reinforces the behavior of creating more passive income. Contrast that with the person who only checks a portfolio balance. That number is abstract. It does not feel like income. It does not change their daily life. So the emotional motivation to build more of it is far weaker. The difference between people who eventually achieve financial freedom and those who do not almost always comes down to this single distinction. Wealth builders think in cash flow. Everyone else thinks in balances. A person with $1 million portfolio that generates no income still needs a job. A person with $200,000 spread across income-producing assets generating $1,500 a month has fundamentally different options. One owns a number. The other owns a stream. And streams compound differently than numbers because the income can be reinvested, layered, and directed, creating more streams. Now let us talk about the 5 specific investments that actually produce reliable monthly income, and why each one works the way it does. The first is dividend stocks, specifically those that pay on a monthly schedule rather than quarterly. Most investors do not know that a specific class of companies, often REITs, business development companies, and certain dividend-focused ETFs, distribute income every single month. When you build a portfolio of these deliberately, the deposits become predictable. The second is real estate investment trusts, or REITs, which are legally required to distribute at least 90% of their taxable income to shareholders. Owning REITs means owning a slice of commercial real estate, warehouses, apartments, medical buildings, without managing a single property. The income arrives monthly or quarterly like rent checks you never had to collect. The third is high-yield savings and money market accounts, which in the current rate environment have become genuinely meaningful. While they are not investments in the traditional sense, they generate monthly interest income with zero risk to principal. For someone building an emergency fund or staging capital for future investments, this income is not trivial. The fourth is bonds and bond funds, particularly short-duration bond ETFs that distribute interest monthly. These provide fixed income in the truest sense of the phrase. And the fifth, perhaps the most overlooked, is rental income from a single income-producing property. One well-chosen rental unit, purchased with appropriate financing, can deposit net positive cash flow every month for decades. The asset appreciates, the debt shrinks, and the income arrives on schedule. Consider two people who both earn the same salary and save at the same rate for 10 years. One parks everything in a growth-only portfolio. The other builds a mix of the 5 income categories described above. After 10 years, the first person has a larger balance on paper, but the second person has something worth more than a number. They have monthly income. When the market drops 40%, person 1 watches their net worth collapse. Person 2 watches their income stay exactly the same. And if they lose their job, person 1 has runway. Person 2 has options. The difference is not intelligence or income, it is the architecture of how they invested. The long-term consequences of ignoring income investing are almost always invisible until they are not. People reach their 50s with strong portfolio balances and no income-generating assets, and they discover that converting a lump sum into reliable retirement income is far harder and more expensive than they expected. The sequence of returns problem, the risk that early retirement market declines can permanently damage a portfolio, is far less threatening to someone who built income streams before they needed them. The people who avoided this trap did not get lucky. They simply decided earlier than everyone else that income was the goal, not the account balance. The solution framework is not complicated, but it does require a shift in how you evaluate every investment decision. Before asking what will this be worth in 10 years, ask what will this pay me every month. That question rewires the entire approach. It leads naturally toward dividend-paying assets, real estate exposure, fixed income products, and structured income vehicles. It also leads toward reinvesting that income during accumulation years, which compounds differently and more powerfully than capital gains alone. Money that arrives on a schedule changes your relationship with time. When you know that a specific dollar amount is deposited every month regardless of what you do that day, the pressure of labor shifts. Not because you stop working, but because the work becomes a choice rather than a requirement. That distinction, choice versus requirement, is what financial freedom actually means in practice. It is not a number in an account. It is a feeling that the month is covered before it begins. Every income investment you build moves you one step closer to that feeling. And once you understand that, the only question left is why you would ever invest any other way in decision.